Is the fear of paying capital gain taxes keeping you from being a savvy investor?
Moving forward with the Dekker team. Moving forward together with the Dekker team.
We are honored to welcome you to episode 734 of Life's Inside Track. I'm Yetta Dekker.
And I'm Ken Dekker.
And it's where we get to share techniques, thoughts, tips, tools, tactics, and truths that we all need, we all deserve. You, I, everyone, so we can turn our house into home, our families thrive, and we build wealth wisely through real estate. This one here is an investment-focused dialogue. If you're not thinking about investing, if you are completely closed-minded, fixed-minded, you want nothing to do with it, you don't have an investment property, you basically want to plug your ears and kind of go, I can't hear you, I can't hear you.
Hold on a second.
I'm going to say stay tuned anyway. Don't go anywhere. Because one of the biggest reasons we hear, right, isn't just, it's not, are the tenants going to be good? It's not, is it going to make good money for me? It's not, I risk losing my money. That's not the biggest reason. Mm-hmm. One of the biggest reasons we hear that people either hang on to investment property that no longer serves them. They wouldn't buy it today if they had a chance because it's just not a good investment anymore. Or they won't start in the investment game because of capital gains tax.
Yeah. And capital gains tax, you don't get taxed unless you made money, right? And making money is not an evil thing. It's money is what, helps the economy go round and round. And
well, it helps us eat and it helps us live. And money isn't exciting for what money is. It's exciting for what the money will do, who we can give it to, who can we support overseas, who can we support locally. It's a much bigger, it's a stewardship conversation. Mm-hmm. So money in and of itself, we all need some. It's difficult to live without any.
Right.
And we don't want somebody else to carry our way, or at least I sure don't. So we get to make money for ourselves and to support and help others that are in need or that we think could benefit from it.
And let's, when you hear the saying 50% capital gains tax, people think that 50% of what they've earned is going to go away. That's not really what it's saying. What it's saying is 50% of the growth is taxable and gets added to your income for that year. And in segment 3, we're going to discuss some ways to mitigate. You can't avoid it. You can't 100% get rid of it. But some ways of mitigating capital gains.
Yeah, the impact of the magnitude of capital gains.
Yeah. And the thing is, if let's say we buy this property and it's $200,000 and we go to sell it just to give a real live example, right? So our listener can pick up on this. Let's say we go to sell it for $400,000.
And you're saying I can't buy one for $200,000. No, you can't today. And when we've been helping clients invest, we're starting in helping people buy $70,000, $80,000, $90,000 investment properties, duplexes and single families and condominiums, different things over the course of the last 35, 37 years. So if you bought 15 years ago, you might have paid way less than $200,000 for a pretty decent investment property.
Yeah. So let's just take 200,000 as round numbers. It grows to 400, another nice round number. Okay, now and let's say it even grows to say 430 or 440, and now you've got expenses like legal fees, commissions to sell it, that kind of stuff. That comes off of your capital gains amount. So let's say your net is 400. So we've got capital gains now of $200,000.
Right.
That is taxed at 50%, which is 100. And let's say it was owned by you and I in both our names. Now we each get to split that 100. So it's 50,000 to you and 50,000 to me added on to our taxable income. Most people sell these properties when their income is lower. So it's not as big a hit. The other thing is if you are selling it early when you have
significant income still.
But we're going to talk about it in the third segment. I almost stole it. I almost went there. But the whole point is the fear of paying capital gains, which is an I don't want to say invalid fear.
Well, I'm going to say that if you make any money, you're going to pay tax on it. This is money that in many ways is passive. You don't actually, the money works for you. Yes, there's some work to do. So it's not 100% passive. And yet it's much more passive than going to work every day and getting a paycheck. Mm-hmm. And so it's money that makes money because it's also leveraged, which again is another show. Bottom line is it's some of the easiest money you will earn.
Yeah. And what I think is irrational, that's the word I'm looking for. It's an irrational fear because the fear of paying some tax is preventing you from earning money or building wealth. That is an irrational fear.
And yet a real one.
It's real for many people. So it's a real
irrational fear.
Yeah. And so it's a valid fear because you're feeling it, right?
Right.
Just like I can't invalidate your emotions because you're having an emotion or I'm having an emotion. Now I can look at that emotion and say, what is it telling me? What is that fear telling me? And what do I need to learn to understand that? Because even if you're in a high tax bracket, you're making over $150,000 a year and you're taxed at 50% on that last dollar you earn. If somebody said, I'd like to give you a raise to $200,000, would you say, no, I don't want the raise because I have to pay 50% tax on the extra $50,000 that I'm earning? Probably not. So
unless you had to work super hard for it beyond what you'd be willing to do.
You're working the exact same thing. You're just getting a raise, a promotion, a raise. And now, yes, you think you're getting 50,000, but you're actually getting 25,000,
right?
Or maybe slightly less. But the beauty with capital gains is even if you're a high income earner and you're at that 50% tax level, capital gains is half tax. So really, the 200,000 you made, it's more like you're paying 25% tax on that. Yes, you'll pay 50% on the 100 of the 200, but it's 25% tax on that 200. So it's efficient.
It is one of the most efficient. Like interest doesn't, if you earn interest at the bank or earn interest on investment, it doesn't have preferential tax treatment. You're paying your taxable rate on every dime of interest that you earn.
Mm-hmm.
So it is a amazing opportunity. It's a deal.
Yeah.
In the best sense of the word.
Yeah. So if the thought of tax is the only reason that's causing you to, that's holding you back
from being a savvy investor.
Well, to look at investments at all, then maybe it's worth pausing to re-examine or maybe have a clarity call with us and talk to us about what your fears are, what your or any misunderstandings or understandings you have. We can go through those quickly. And you're going to do that by jumping on our website at dekkerteam.com and booking a 15-minute free clarity call, right? So Winston Churchill said this, Yetta, fear is a reaction, courage is a decision. So once we release fear, the next step is understanding what maybe some of the smart exits actually look like. So join us in segment B for that. And we're glad that we're able to build wealth wisely through real estate because it's about much more than just money.
Moving forward with the Dekker team. Moving forward.